Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
interest rate is the charge to borrow money. It is generally expressed as a percentage of the principal amount borrowed. Interest rates are debt to borrowers and returns or earnings to lenders. For example, a $1,000 loan charged at a 5% interest for 5 years means that the borrower will have to pay $250 in interest after 5 years, plus the original $1,000 loaned. In financial products, interest rates for credit advances and loans are generally expressed as annual percentage rates, or APR, which factor in additional fees, and effective annual rates, or EAR, which factor in additional fees and whether the interest compounds on a smaller time frame than annually. Annual percentage yield, or APY, is the same as effective annual rate, but from the perspective of the lender rather than the borrower. APY is typically shown by banking institutions for various financial products, such as a savings account or certificate of deposit. Interest rates can broadly be divided into fixed interest rates. This type of interest rate pays out or charges a constant amount at a predetermined rate through the life of the financial security or loan. Interest rates for savings accounts are generally fixed interest rates. Variable interest rates. This type of interest rate changes based on external factors, such as central bank policy or inflation. For example, interest rates for adjustable rate mortgage loans are variable and change with the federal funds rate, or prime rate, the rate at which banks lend to each other. The Federal Reserve determines the baseline for all other interest rates by establishing the federal funds rate. Other interest rates are computed as the federal funds rate plus a premium for the risk the lender incurs from the borrower defaulting on the loan, sometimes called the market risk premium. U.S. Treasury bonds have a payout roughly equivalent to the federal funds rate, since the U.S. Treasury can print more money if necessary and has no risk of defaulting on the loan. All other borrowers have risk, some more than others. A financial institution calculates interest rates for loans using a complex set of variables. Some of them are central bank's rate. This is the federal funds rate. Borrower credit history. This is largely determined by one's FICO score. Time frame of borrowing. Whether the loan is collateralized or whether the bank can take an asset as collateral, such as a home in the event of a default. For companies, how highly leveraged or how much debt the company already has outstanding. In general, borrowers with a good credit history qualify for lower interest rates from a lender, and vice versa. Interest rates play a critical part in an economy and control the flow of money. High interest rates slow down an economy. On the other hand, low interest rates can accelerate its growth by encouraging investors and consumers to borrow and spend. Let's hear from you. Can you think of a benefit that fixed interest rates have over variable interest rates which change over time? Leave your answer in the comments below.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.